Right now, some of the biggest names in tech are bleeding red, and a lot of everyday investors are starting to panic, wondering if the AI boom is quietly falling apart in front of their eyes. But what if I told you this exact kind of fear is usually where the real money gets made, not lost? Before we get into it, if you're someone who wants clear, no-nonsense stock ideas without the hype, hit that subscribe button right now, because on Ticker Hawk, we break down exactly where smart money is moving while everyone else is busy panicking. So here's what's actually happening. We just stepped into the third quarter of 2026, and the chip sector has taken a noticeable hit since the highs we saw back on June 22nd. The semiconductor ETF that tracks this whole space is down close to 15% since that peak, and if you've been watching your portfolio the last couple weeks, you've probably felt it. Individual names look even scarier on the surface. One storage-focused chipmaker has dropped nearly 30%. A major memory player is down around 25%. A well-known chip giant has slipped 20%. And even a household name in processors has lost around 13%. Meanwhile, one networking and a custom chip company has only slipped about 5%. And one AI-focused chip maker has barely moved at all, almost like it didn't get the memo that everyone else is selling. Now, the question everyone's asking is simple. Is this the end of the AI trade, or just a breather before the next leg higher? My honest take, this looks like a healthy pause, not a breakdown. And when quality companies get discounted like this because of short-term nerves rather than any real change in the business, I don't run away, I pay closer attention. But chips aren't the only place opportunity is sitting right now. Other sectors have been quietly underperforming the market for far longer than the last couple weeks. And that's where today's video is headed. I get one question more than almost any other. If you had fresh money to put to work today, where would you actually put it? So in this video, I'm walking you through 4 stocks I've personally been buying and why each one made the cut. These aren't necessarily the cheapest tickers on the market, and they're definitely not the loudest names on social media. They're simply businesses with serious long-term potential, strong leadership, and more than one catalyst that could push earnings meaningfully higher, at prices I think make sense. When I put money into a stock, I'm not trying to guess what happens in the next week or even the next month. I'm trying to own pieces of businesses that I believe can keep compounding value for 1 year, 5 years, 10 years, and beyond. So let's get into the first name on my list, and that's Robinhood, ticker HOOD. A few years back, most people thought of this platform as just a meme stock playground or a spot to trade crypto. Honestly, that description doesn't hold up anymore. Today, this company has grown into a much bigger financial ecosystem. It's not just stock trading anymore. You've got retirement accounts, credit cards, cash management tools, crypto access, securities lending, and it's slowly becoming a place where people manage a huge chunk of their entire financial life in one app. Over the past 12 months, the stock has climbed more than 20%, and it now sits at a market valuation of roughly $100 billion. What really excites me is how the company keeps rolling out new products that deepen customer engagement. The more services a customer uses on the platform, the harder it becomes for them to ever leave, and the more valuable that customer becomes over time. Just around the 4th of July, they launched a brand new account type that's already gaining serious traction. And it's currently exclusive to this platform, meaning it can't simply be moved elsewhere. I think this growth driver is massively underestimated right now. On top of that, we're still in the early innings of retail investing. Younger investors keep entering the markets, and this brand remains one of the most recognized names among that generation. As assets on the platform keep growing and the company expands into new countries, I believe earnings have real room to expand significantly, and that's why this stock made my list. Before we move to the second pick, drop a comment down below and let me know which one of these 4 you're most curious about, because I read every single comment and I want to know what you're thinking. All right, stock number 2, and this is one I actually bought on the very day I sat down to put this video together. That's Broadcom, ticker AVGO. A lot of people ask me how I managed to keep track of this many companies without losing my mind, and honestly, it comes down to focusing on a handful of things every single time. The trend in the business, the trend in the stock, and whether the current price actually reflects where the company is headed. I'm not chasing every headline or trying to time the exact bottom. I'm just watching for the moment when a great business gets temporarily mispriced because the broader market is nervous. Pulling up Broadcom, the stock is up around 45% over the trailing 12 months, but also down close to 20% from its early June high, which is exactly the kind of pullback that catches my attention. That combination, strong long-term momentum, paired with a sharp short-term pullback, is usually where I start digging in harder. Okay, so what's actually going on with this business? While one particular chip company gets almost all the media attention in the AI conversation, this company has quietly turned into one of the most important players in the entire AI build-out, and most people don't realize it. Most investors think of this business purely as a networking chip company, but what actually excites me is its custom silicon division. Several of the biggest tech companies on the planet are now designing their own in-house AI chips, instead of relying entirely on off-the-shelf hardware. And this is the company helping many of them build those custom chips. We're talking about direct partnerships with some of the largest tech giants in the world, all working with this company at different levels to bring their custom AI silicon to life. This custom chip relationship is, without question, the single biggest growth driver and the core reason I decided to buy shares. But going back to the bigger picture here, this is a company that hasn't just built products, it's built deep, sticky relationships with some of the wealthiest corporations on Earth, companies that are pouring tens of billions, sometimes hundreds of billions of dollars, into AI infrastructure every single year. And this business benefits from multiple angles at once: AI networking hardware, custom chip design, infrastructure software, and enterprise technology. It's not a one-trick pony riding a single trend. It's tapped into several massive tailwinds simultaneously, which gives it a lot more staying power than people give it credit for. To me, this is quietly becoming one of the backbone companies of the entire AI ecosystem. Right now, the average analyst price target sits close to $525 a share, which implies somewhere around 40% upside from where it trades today. Now let's talk about stock number 3. And this is one I've been telling people in my community to accumulate ever since it dropped below the $100 mark. This is ServiceNow, ticker NOW. This isn't the flashiest name you'll hear about on AI Twitter, but it's genuinely a mission-critical piece of enterprise software. And here's the key part. Artificial intelligence isn't replacing this business, it's supercharging it, and it could end up being one of the biggest winners from enterprise AI adoption over the next several years. In recent weeks, we've actually seen analysts upgrade their outlook on this stock, pointing to both the attractive valuation and the near-term execution around AI features. This company has built an incredible workflow automation platform that helps large businesses streamline everything from IT support to customer service, human resources, finance, and daily operations. Now picture layering artificial intelligence across every single one of those workflows. Instead of just helping employees move a little faster, AI can actually eliminate a huge chunk of repetitive manual work altogether, freeing up time and budget that companies can redirect elsewhere. That's exactly where I see enormous upside for this company going forward, especially as more enterprises look for ways to cut costs without cutting headcount. Shares here have actually fallen a steep 45% over the past 12 months, and the company currently carries a market value of around $110 billion. At its peak a couple years back, this stock traded near $250 a share, and today it sits around $110, which tells you there's a massive gap to simply get back to previous highs, and I genuinely believe it will close that gap over time. This business already has extremely deep, long-standing relationships with some of the largest enterprises on the planet, and layering new AI capabilities onto an existing customer base is almost always easier than winning brand new clients from scratch. I think this company has one of the strongest combinations anywhere in enterprise software of recurring revenue, high retention, and a real path to monetizing AI. From a valuation standpoint, the stock trades at a forward earnings multiple of just 22 times, while earnings are projected to grow roughly 22% next year, giving you a valuation to growth ratio right around 1, exactly the setup value-focused investors love. Analysts currently rate this a strong buy, with an average price target close to $141, implying close to 30% upside from here. Quick favor, before we jump into the final pick, if this video is actually helping you think differently about where to put your money, hit that like button, and share it with someone you know who's also trying to figure out where to invest right now. It genuinely helps this channel reach more people like you. And now, the fourth and final stock on today's list, and this one might catch a few of you off guard. Booking Holdings, ticker BKNG. This company has nothing to do with chips, data centers, or AI infrastructure directly. It's simply one of the highest quality businesses in this entire space. Yes, it's cyclical, and its performance is tied closely to the broader economy. But I believe the economy is holding up far better than most people expected right now. Manufacturing data has been improving. The job market isn't booming, but it's holding steady, and businesses across the board are still generating solid profits. All of that tends to be good news for consumers, and consumers, generally speaking, love to travel, especially after a couple years of holding back on bigger trips. This company generates massive amounts of free cash flow, and if you've watched this channel for a while, you know how much I value businesses that consistently throw off cash. It holds a dominant position in global online travel booking, and management has done an excellent job allocating that capital efficiently over the years. Back in 2026, this stock got dragged down alongside a broader sell-off in software names, and shares are currently sitting about 20% lower over the past 12 months. What really excites me is how this company is weaving artificial intelligence into its platform. This is where investors disagree. Some think AI is a threat to a traditional booking platform. Others think it's a massive advantage. AI has the potential to make trip planning dramatically simpler through personalized suggestions, custom itineraries, smarter support, and better search. I've experienced this. Firsthand, I recently took a 3-week trip through Europe and leaned heavily on an AI assistant to plan most of it, and many of the recommendations got booked directly through this exact platform. Sometimes the biggest winners in a new technology cycle aren't the companies building the technology itself. They're the companies smart enough to use that technology to make an already great business even better. This company fits that description almost perfectly. Analysts are also fairly bullish here, rating it a buy overall, with an average price target near $225, suggesting more than 20% upside from where it sits today. I personally view this as a strong way to play a rebound in consumer spending and discretionary travel demand. Now, you might have noticed something interesting about these 4 companies. They're spread across completely different corners of the market. One is in fintech, one is in semiconductors, one is enterprise software, and one is global travel. So why did all 4 make my list? Because every single one of them has multiple different paths to grow earnings over the next decade, not just one narrow story that could break down overnight. None of them are dependent on a single product, a single customer, or a single trend to keep growing. I'm not buying any of these hoping for a quick pop next week. I'm buying them because I believe they have real, durable advantages, strong leadership, and long runways of growth ahead of them. Markets will always move up and down. That's just the nature of investing. And honestly, if it didn't feel a little uncomfortable sometimes, everyone would already be rich. But over long stretches of time, it's earnings growth that actually drives stock returns. And that's the entire lens I'm using here. Right now, these 4 names check every box I personally look for. Quality businesses trading at prices that make sense to me. Will there be bumps along the way? Absolutely. Every single stock goes through rough patches. But if these companies keep executing the way I expect them to, I genuinely believe that people watching this video today might look back several years from now and realize this exact moment, right when everyone else was panicking, was actually one of the smartest times to start building these positions. Before you head out, drop a comment and tell me which of these 4 stocks you already own, or which one you're planning to look into first. And if you found this breakdown useful, do me a favor and share it with someone who's been sitting in cash trying to figure out what to do next. Make sure you're subscribed to Tickerhawk so you don't miss the next breakdown, because there are more opportunities like this showing up every single week, and I'll see you in the next one.